at the end, everybody wants to grow their lawn care business. Or some people might not. They have enough lawn. I have enough business. Phone rings too much. I don't want any more. We got a few guys like that we run into. But most people I talk to, they want to grow their business. They want to increase opportunities for them, their family, and their employees. However, a lot of people say, I'd like to grow my business, but gosh, I got to invest money into marketing and I got to invest money into sales, and I don't have the money to do that. So how do I fund my growth? Well, one way to fund your growth is to get your customers to prepay. And a lot of people get their customers to prepay, but some people, if you're not getting your customers to prepay at all, I highly recommend you offer a small discount and give people the opportunity to prepay, and you will be amazed. 10 to 40% of your customers will prepay, depending on the opportunity, depending on the promotion you give them, and depending on how focused you get at doing it. If you can get your customers to pay you in advance in November and December and January and February, then you can use those prepaid dollars and deploy them into marketing in January, February, and March, when marketing makes the most sense. And so prepays are a great source of funding growth. The challenge is it's got to be cost efficient growth, because if you get a bunch of prepays, and you don't get cost efficient growth, you can spend a bunch of money in marketing and then not have enough profits to keep your business going. So it's something that really important that we measure the ROI, return on investment, that we get from our marketing dollars. Remember, whatever you measure, you improve. And so it's not enough to just spend dollars in marketing, but you got to spend dollars in marketing that you know you're going to get a return on investment. So when I say return on investment, how do we figure that out? Well, think about your gross margin divided by your cost per sale. So if you look at your gross margin for your business, that gross margin is not your net profit, but just your gross profit. So gross profit, you think about in a lawn care business, it's the cost it takes you it costs you to just do that job, just to fertilize that lawn. So that's the direct labor to fertilize the lawn. It's the truck cost spread out over all the lawns, the fuel cost, the fertilizer chemical cost, and the labor to do that lawn. So it doesn't include your secretary, it doesn't include your salespeople, your marketing, your insurance. None of that is in your gross margin. And so a typical lawn care company, gross margin dollars end up being 40 to 60% gross margin. That's a typical lawn care. They vary wildly across the country, but if you just want to say typical, 40 to 60%, let's just say 50% is our gross margin, just to kind of use it as an example. If we say our 50% is our cost per marketing, is our cost per sale, if our gross margin is 50% and our average customer gives us $400 on an annual basis, so $400 to take care of their lawn, the gross margin at 50% means we get $200 in gross margin from that customer. So if we get $200 a year from that customer in gross margin, then we got to look at what's our cost per sale. Cost per sale is all the dollars we spend in marketing and in our salespeople and our salespeople's commission. You take all your marketing costs and all your selling costs, you divide it by the number of sales that you get, and that gives you your cost per sale. So if you spend $100,000 in sales and marketing for the year for, let's say, a sales guy plus all the things you're going to do to get him leads and pay his commission and that type of thing, and he gets 1,000 sales for the year, $100,000 cost. You take 1,000 divided by 100,000, you get $100 cost per sale. If our gross margin per new customer is $200, then we will pay for that customer in half a year, because our cost per sale was $100. Our gross profit over the course of an entire year is $200. That means we have $100 that gets paid back to us in 6 months, and then the next $100 is ours. So the marketing dollars come off of your gross margin, if that makes any sense. $200 gross margin on a $400 annual revenue per customer with a 50% gross margin, $100 cost per sale in that example I just gave you, you pay for that customer in less than a year. That's a really good ROI. Anytime you can invest dollars into sales and marketing and get those dollars back in less than a year, typically you're winning. So let's move on to the next slide. And I just kind of covered that with cost per sale. So I covered this thing. Now you got cost per lead and you got cost per sale, two different things. So cost per sale, we spend all of our dollars in generating leads, in measuring the lawns and selling the lawns. We divide that by the total number of sales we got. That gives us our cost per sale. Cost per lead is different because we don't sell every lead. So anytime the phone rings and somebody asks for an estimate, or anytime if we reach out to somebody, knock on their door, or do a direct mail call to them or do any kind of a advertising piece. We look at the total leads that we got, total number of people that called us for an estimate, or total number of estimates we performed, and we divide that by our total marketing costs. So that's marketing costs is just the things we spent to make the phone ring or make people call us. It's not our salesmen necessarily, unless they're generating leads. So you take your total number of leads, you divide it by your total marketing cost, and that gives us our cost per lead. So it's really important that we know our cost per lead and our cost per sale. Cost per lead will typically be much higher than your cost per sale because we don't sell every lead. Let's assume that our cost per sale is $100, and let's assume our close rate is 20%. And that means our cost per lead was probably around $20 because we sell 1 out of 5. So that means we need 5 $20 leads to get the one, sale that generated $100, that cost us $100. So cost per lead is very important to understand. And if we can understand cost per lead per vehicle, so let's just say we did Angie's List. What was our cost per lead for Angie's List? Let's just say we did direct mail. What was our cost per lead for direct mail? Let's say we did door hanging, and we had our technicians hang pamphlets on people's doors. What was our cost per lead for that? If we can measure cost per lead for each one of our marketing pieces, then we can measure which ones are more efficient. Obviously, if we have a lower cost per lead, then we want to do more of that kind of advertising. But we also want to look at cost per sale per vehicle as well, because we may get a lot of leads on something that have a low conversion rate, which means that we may have a low cost per lead but a high cost per sale. Or we may get just a couple of leads from something, but they all close, or a high percentage of them close. So it could actually have a high cost per lead and a low cost per sale. So you got to look at both cost per lead, cost per sale, and as targeted as we can be with those costs per advertising vehicle, the better we can measure the results. And whatever we measure improves. And if we find something that works, do a lot more of that. And if you find something that is driving your cost up, then stop doing that. But you need to measure it. If you don't measure it, you're never going to know.